So, welcome once again. I guess we are starting the new year, and I think it was very interesting last year as we were discussing right before we started recording. So, first of all, yeah, I think a happy new year to the community. I think as we always try to look at weekly, this time we will try to see more than a week, probably a quick review of 2025. Let's try to see where what market is telling us. As usual, I think you can always put the questions, or after the market review, we will always have an opportunity to discuss further. Before I jump into the markets, just one quick announcement. So, as I think we are preparing our Investor Day event for February 1st. So, more information will be very soon shared. I think our goal here is again, the main theme this time is we have three back-to-back years of, I would say, double-digit S&P 500 returns. Tech is sitting on really big runway, or last 3 years of great up move. So I think what we are projecting now is that things are getting more and more difficult. Like it was like we had this whole mega trends of huge runs of AI, huge run of Bitcoin and crypto. Now I think some of the easy trades like gold and silver, which we were seeing last 2 years, they have run up too much. So it's not going to be easy anymore. It's not going to be like kind of the uptrends are probably in final leg, probably in late stages. Again, I don't want to speculate right now because it's much more nuanced than just saying that it is the last stage. But I would say there is definitely a huge, the 2026 is looking like will be higher risks for the same rewards. Um, but of course, there are opportunities always. There is always going to be, like, as we call it, the K-shaped market. Earlier, it was a simple up move. Now there will be winners and losers. So we call it K-shape, where some will go up, some will go down. And that's where I think we are spending a lot of time. And we plan to discuss all those things in the new Investor Day event, which is planned for February 1st, with all the data. As usual, we talk about how do we make it very much filtered from the actual data rather than trying to worrying about headlines. All right, so let's share the let's, as usual, what we do is we first look at the markets, right? So where we are. So let me just quickly go over there in the charts, and we can start from there, so that we are able to have a quick look at that. So I'm trying to zoom out here to a full year view. Let's see if this is possible here. Um, so this is what the last year looked like on a chart. I mean, of course, there are last few days if we ignore. Um, so it was a pretty interesting time, right? Means we started with a very big change, means politically in US, and a lot of concerns around what Trump will bring. And as it happened, he did shake up the market. Just as a reminder, so what happened was we had a huge drawdown on the so-called Liberation Day and the tariffs. Even before the Liberation Day, the markets were very concerned about the tariffs. So I think the story remained mostly around tariffs for the first half. And as market had and as we all remember, right, there was a V-shaped recovery like this. If you just ignore this portion of March, April, you can almost see the trend is same. We on S&P 500, so we continued, and market completely wrote off the tariffs. The idea was that everything was taken into the stride because ultimately it was a technology rally. Most of the software players or the tech players they were not impacted. There were a lot of exemptions. So that is, I would say, it was a panic story in the first half, but I think market became settled, very much similar to what was happening in previous years. On the other hand, we did discuss last year how the policy started changing. So just like the end of 2024, when we had quick three rate cuts, 2025 also gave us rate cuts, and that further consolidated the rally, and we made new all-time highs. Now, on the other hand, if you see, it was a pretty much from Liberation Day or the April downs all the way to October. We had almost a one-way up. There was some movement, but hardly anything. But what happened in October onwards, we kind of hit a ceiling. If you see, even though it looks like we are at all-time high, we had a pretty much saturated S&P 500. Means if you look at some of these highs, they are within like 30 to 40 points. There's while there were corrections, which were some were deeper, which were in November, some were shallow. But overall, what was happening, I think it's very easy to see when you look at Nasdaq. I would say Nasdaq did not make its all-time high again after hitting in October end. And that tells us that tech started to struggle. So especially people who are in tech, especially people, and again, I think we will talk about Bitcoin, but the other part of the story was some of the mega trends like Bitcoin never ever recovered in the last quarter. So this doesn't even feel like all-time high if you look at from tech perspective. If you look at from even though SPX did make all-time high, and right now as we speak, today we made another new all-time high. But if you see, Nasdaq is still pretty much struggling to get to the last all-time high. So what is really happening here is the market is rotating. And as we see, there's a lot of, means we can read it two different ways. One, and we can go through maybe some of them, like for example, Nvidia, which made a high of 210. It is sitting like quite distance from there. If you look at like Avago, it corrected. If you look at Meta, which corrected heavily. So all these are Mag 7, which were used to be popular, like Apple, which is even though Apple made a new high in December, later than while it was market was rotating, when most of the other ones, the leaders, had made highs in October. I think if you look at Microsoft, which is another big struggle, I think this is one big component of tech and the mega cap, which has really struggled. As we discussed, I think last year we discussed quite a bit about what is happening. The whole ecosystem was shifting from OpenAI-led ecosystem to something like Google. So, but what happened? Like, how did we rotate? I think Google was the winner towards the end. We saw companies like Micron as a memory shortage came into highlight, and as we see the prices are going up. So some of these players started seeing a lot more, new highs. And I think Tesla made a new high toward late December. So as you can see here, across the different tech players and the mega caps, we are seeing that many of them are struggling because there was a correction. So the fourth quarter did not really feel like that we are in a rally, which was very easily visible, where all the stocks are going up. And this is exactly what I was talking about. Probably 2026 will look like, because there were two things, right? One is that we were sitting on a pretty much like as we were discussing, if you remember when we started 2025 and when we had our first investor day, I had talked about, even though a lot of people were skeptic, I had talked about how there's a huge tailwind and we are not nowhere close to the top in AI trend. And that came true, except for the tariffs, right, which really rattled the market for a short time. But ultimately, the trend caught up. Now, is it true again? Probably. I wouldn't say that we are in the middle of AI trends, because now we have other issues in emerging, right? Earlier we were spending from cash flow. Now we are raising debt for spending. There are question marks over whether the spending, now it's a real question mark. I would say last year it was a little bit of a panic, and where we were not really agreeing. I would say now there are definitely some concerns emerging. But what is different now? Now let's talk about macro. What is different is we stopped the QT, and we have now starting QE. And what is happening there is that there is definitely a tailwind of that, but market is already pricing in, like that there will be a little bit of a bottoming out the long term rates, because while this whole easy policy is starting in US. Now the question is, can the long end of the rates maintain this downtrend? And let's have a quick look at that as well from a perspective of where we are on that. So while we talked about starting on 2025, we were at peak yields. Market was concerned about inflation. Market was concerned that there's a call for rate cuts. Everybody was worried about whether as we go towards change in policy at some point, and we had already been cutting rates. So when we were cutting rates in 2024, towards the end of it, the long end of the yield curve was going up, which was kind of a situation which was not pretty. This was one of the concerns in the market. But I would say, as this is very interesting, and this is one thing which Trump has always maintained, and the Trump administration, like Besant, have always said that 10 years is their focus. I would say that they were pretty successful in bringing the 10-year yields down. And we are still in a downtrend, even though, if you were in these calls, we were always talking about these slopes. We have actually broken out of the steepest slope, which started in July. We have now even broken out of the second slope, which I was tracking. Now we are at the last slope, which we are tracking. So I would say at this moment, I would still call it a downtrend till we don't cross above 4.3%. So 4.3% is where I would start worrying about it. Even then, I would not worry because we are still, the long-term average is still going down. I would say the panic on the long end of the rate start at 4.5% or so. But overall, what does it mean? While there is definitely a risk of this going up as the more short-term rates come down, and as we discussed in our WhatsApp channel also, now Trump is already talking about buying back the MBS and so on, the mortgage-backed securities. So they are definitely into the yield control. So I think the policy heading into the election year can be very accommodative. This is a midterm year, so that is another part which we are going to discuss in our Investor Day event with more details on what we are seeing and what are the possible data points which we should be tracking. But overall, something to watch out, I would say, how the yields behave in terms of the macro push, because ultimately, as we always talk about in Proflex, that markets follow the money, and if your money supply increases, if liquidity increases, which really helped uh, after the shutdown, after as we have seen that there was a lot of panic towards the November timeframe when the market corrected. We came back mainly because of that. And what contributed is, if you see, which is the wider index, while the tech was still correcting, there was a rotation into small caps and other stocks. And this for good reason, to be frank, because the policy is accommodative, and most of these stocks, the smaller caps, were struggling all through last 2 3 years because of higher rates. So I think that's where we are on. I would say just as a big picture of what happened last year. And as we said, there are two push and pull factors now. First of all, the tech. I think January earnings will be uh, very closely watched, whether the earnings can continue showing the growth which we saw last year. Most of the analysts are predicting pretty good earnings growth even now, and that can again bring Nasdaq into focus, and tech stocks can actually get us to new all-time highs because, as you can see, tech is yet to catch up, while S&P is sitting on all-time high. The second part is, of course, crypto, which has to still go up. And let's have a quick look while we are talking about it. So Bitcoin, as we were discussing, it not only broke down from October, but it also broke down again in November. And it is kind of bottoming out, I would call it. From the chart perspective, we are seeing a small uptrend forming since late November, but I think it's still not out of the woods. Overall, I think there's a lot of concerns around what is happening with the displayed treasuries, and people are, I would say it's a more of a rotation into the institutional money is rotating into gold and silver. And let's quickly have a look at gold and silver, which are continuing kind of a mega trend, which we have been tracking for last 2 years. If you are with us in All Access or in Proflex events, if you have attended, we have always maintained that this would be one of the biggest uptrend, and it came true. And it is how we are seeing right now it's playing out. But as just like AI trend, I would say this is becoming more and more difficult now. It's very difficult to say now is a good time to enter into these trades, because gold and silver are becoming, pretty much exponential. Like if you see silver, it almost went exponential in last couple of months, and and as usually what happens towards the end of the rally, you see a lot of volatility. So if you look at the bars, look at the corrections which happened. There was this news about how some of these silver shorts got liquidated, and then there was a lot of churn. These were like almost a 10% moves per day kind of events we are seeing in something like a silver or a commodity, which is unheard of. But this is normal in these times after you go through exponential moves. So again, while we were tracking these things last 2 years, and as I said, if you are part of Proflex, we have been talking about this, that these were the trends which were easier last 2 years. They're not easy anymore. You cannot, even though the tailwind is there, even though silver and gold can go further up, it's much more difficult to play when you are sitting on 150% up move in both. So this is what I think the story will be for 2026. Things are going to get a little more difficult. So you have to be a little more careful in planning your portfolios. You cannot just buy and hold anymore. You have to be, means probably sit in either very, very safe instruments or actively manage. That's our view. But I think in terms of opportunities, just like we saw, everything turned around. As we did talk about Micron, like what happened here is, it was a very obvious thing. at some point the memory prices will start going up if the demand can sustains. And at some point, this whole dynamics between demand and supply triggered. I'm sure some people are tracking SanDisk and some other memory players also. But overall, I think there are going to be winners, even in the late stage, as you can see. Like Google is another example that they turned around after Gemini. So if you have the right, you know, kind of focus, you can always find winners in this kind of a market, which was kind of struggling, and which will struggle as a whole unless we see the next leg of, where is the growth going to come from. So what are the opportunities? I would say opportunities are going to be as we go along into, as I said, again, the earnings. Like, if we maintain across the board some kind of, whether AI can keep proving itself, which is, and I was comparing before we started the recording, we were talking about how the last 3 years are looking like .com. Remember that when this last time it happened that we had double-digit gains in S&P 500 in .com time, we had 5 years of rally, not 3 years of rally. So it's not like it's unprecedented. It can happen, and if AI can really deliver at the same level, probably we are still not there. So those are the kind of discussions I think we would, of course, double click on it as we go along in this year. And also, as I said, we have this February 1st of our Investor Day event. Our goal is to double click on all these things and get a little more deeper into what we are seeing. But I think that is where the status of the market is. That is where I would say very interesting times with we are sitting on the top with a lot of opportunity. With this is the first time I would say where means I don't remember any other time when we are seeing QE starting. We are seeing an election year where there will be a lot more policy push, and we are seeing market sitting on all-time high. So can we blow it up? Yes, definitely. It can keep going. And secondly, the opportunity can be from the same trends, I would say. The AI trend, the tech is, as I said, it's not all-time high. Crypto has an opportunity to come back now that the money uh, situation is reversed, because we were struggling through the 2025 as the QT was progressing, as the liquidity was shrinking, as the shutdowns was impacting the liquidity. All those factors created very negative, I would say, kind of a scenario and a lot of headwinds for assets. While even with those headwinds, we were seeing gold and silver rallying. So it's not easy. It was I think it's not directly correlated, as you can see. Like typically you would expect gold and silver to behave similar when the money supply is shrinking, and not really shrinking, but the liquidity was like money supply is always increasing, as we have discussed multiple times. But what I'm trying to highlight is the liquidity was still not good in the periods when we were seeing a huge rally in gold and silver. So I think it will be interesting to see, just like in the start of 2025 and 2024, we were seeing all the new liquidity going into Bitcoins and of the world. And last year, we were seeing silver being attracting. And right now, in the current era, we are seeing silver and gold attracting all that liquidity. There's always this rotation. And that is something which is very fascinating, and we will keep monitoring. At this moment, I would say one has to definitely worry about not just buying and holding, because all these things are changing every day. Like as we talked about towards the end of the last year, even in AI trade, there was this whole ecosystem, OpenAI ecosystem moving to Gemini ecosystem, and the Google and Avagos of the world starting going up. Now the memories companies going up. So there's always this active management which can help. But I think overall, if you are passive investor, we are recommending that index investing is the best, because ultimately these things average out. But other than that, I would say it will get more and more difficult to pick winners in 2026. So that's a summary quickly. I would stop here and take a few questions on what people are feeling and how, what is their view on how 2026 is starting. I see a question in the chat. Let me take that first. In the meanwhile, while anybody else wants to put up a question, feel free to unmute as well. So I think one of these questions is saying, are these returns mainly due to dollar devaluation? How do we extract real growth versus devaluation impact? I would say the level of growth we have seen cannot be correlated to dollar devaluation, because we have discussed this previously. Um, on a longer term horizon, 10 to 20 year horizon, dollar is probably behaving very similar. If you look at 1 to 2 year, yes, there was little more devaluation, but I don't think we can correlate the dollar devaluation to that. In fact, um, most of the, I would say on an average, if you see 10 to 15 or 20 years cycles, dollar is pretty much just not devaluing. Um, so I would say the real growth right now is coming from two factors. But when you say growth, I'm assuming you're not like we are not talking about overall inflationary forces, right? Because the money supply is increasing, so growth in price will happen because of money supply anyway. But relative growth is happening because of technology. Mostly, I would say this is a trend of technology. Most of the returns have been generated in last 3 years because if you take out the AI, I don't think we would see anything more than 5-6% gains in any of the indices. So I think it was purely driven by the technology, and you can call it innovation. And the hope is that it can start delivering into actual what we can call it as a productivity gains, and what internet provided, what cloud gave us. There's a lot of bets on AI providing the similar level of productivity increases. Um, I think another question I see in the chat is the forecast for continuing earning growth. So again, I'm not going to take risks of speculating on that, because at this moment, I would just go by what analysts are saying. And if you look at average analyst expectations, then the earning growth is pretty solid. I don't think anybody has put a stop to it. I think if you look at the forward PE of most of the Mag 7, they are looking very attractive. The growths are, means again, I don't have the numbers in front of me, but I don't think they're anything which are slowing down. But on the other hand, some of the stocks are already priced for that growth, because though most of the analysts have been projecting this for last 2 years. So having said that, so it's not straightforward that earnings may grow for much longer than the stock price, because stock usually try to price the market 12 to 18 months ahead of time. If at any point earning growth is expected to slow down after 12 months or 18 months, the stock will top out right now, not 12 months later. So at this moment, I think earning is usually the lagging factor. You usually hear about earnings way later than what the smart money and the investors will start pricing it. Um, at this moment, when we are sitting on the top, so it's very clear that the next 12 months earning probably are seen as good. Otherwise, you would have already seen the correction starting. And in some stocks, it's already starting. Look, if you see Apple has underperformed, or if you see, means just some people are predicting that it's tough for Apple to catch up to rest of the earnings. But if you look at stocks like, in semiconductor, almost that is what is leading this rally. I think almost all of them are probably sitting on near their top, or probably a little bit down from their top, because they are not expecting the earnings to slow down in next 12 to 18 months. So, and again, I think one thing is estimates, and then second thing is, as we have seen over and over again in recent times, when you are in a huge bull run, um, market wants even the companies to even beat those estimates. Every time a company has failed, even sometimes after beating the estimates, stock falls after the earning. But definitely, if you don't beat the estimates, if you just meet the estimates in this kind of a environment where we have, 3 years of bull run with almost every stock has gone 5x or 8x, earnings will have a little higher bar every time. So it will be very interesting how January plays out. I think we are very close to the next earning cycle. So it will be interesting how market reacts, because definitely there is a room for technology companies to run up, as we discussed on the chart. But on the other hand, the expectations are also very high. And if they beat, and if they continue showing the growth, I'm sure the market will reward them, because earning is not good earning is a very much a subjective term, because there are, as I said, there are analysts and there is a range of opinion, and those ranges are very big from analysts. So I don't have any specific opinion, but I think it's very clear that right now we are not at the top of the tech earnings for sure, because and if that top has reached at any point, we would already be correcting pretty heavily before that. That is how I see the markets usually. But yeah, I think it's a good question, and especially entering into, I think within 2 or 3 weeks, if we will start seeing those earnings, I think another 2 weeks from now. So we will have pretty good probably we'll have good discussions here, and we can talk about that. But overall, I think with the valuations being so high, with the such a huge rally behind us, we will see a lot of, as we say, K-shape, right? Means this is what is now going to be my favorite term. If you're going to be talking like within Proflex, we're talking a lot about K-shape. We will see some going up and some going down, and that is going to be very interesting to see um, how these tech players are rewarded and who get penalized. We already saw that in fourth quarter, as we were discussing on the charts. We already saw that happen in fourth quarter. Some of these stocks, like Microsoft, is sitting on probably more than 15% correction from its high. And it is one of the like second or third highest cap company um, in the whole index. So imagine when the index is sitting on all-time high and making new highs, Microsoft is so far down. So it is one example, and there are many such examples right now. Uh, so probably market is already pricing in that they will not be able to grow their earnings in the same manner. And as I said, Apple had underperformed earlier last year. There are a lot of other stocks which, on a case-to-case basis, are underperforming, and that is because market is having questions about their growth. And that is what happens in the later stage of the rally, where not everybody can keep the market happy, because market is always looking for reasons. After a 500% growth, you're always looking for somebody to get out and consider different opportunities. It's not going to be easy growing from here and going another 2x on these tech stocks. All right. Any other questions? Feel free to uh, put in the chat, or we can also unmute your and you can ask the question. All right, so let me see what were the other topics we were planning to discuss. So the other thing I think we wanted to discuss is we talked about the policy, we talked about what is going to happen, in the earnings and AI trade. The other factor which I think I wanted to discuss, which is going to be very critical for the markets, is the geopolitical one. As we have seen, I think last few weeks or so, there are definitely big changes happening. Means, of course, tariff was in the news last year. That has become kind of old news. Probably means even today we were expecting Supreme Court to rule something around tariff, but market almost did not pay much attention to that whole news that got delayed. So no, what we are seeing is that I think market has understood the whole tariff impact, even if it is one way or other. But I think what market is still struggling with is these big changes happening. For example, what happened with Venezuela, what is happening in Iran, the provocations which are continuously happening from US side right now into something like where means I would call it as a, again, if you remember, we had this whole discussion during our one of our investor days last year, that it is becoming a bipolar world. We have US and China as a superpowers fighting. Venezuela action is all about I would say, protecting one from China, right? They are very directly confronting China and saying that you cannot go and come to the Western Hemisphere and start partnering with Latin American companies and so, or countries and so on. So I think this is definitely accelerating the whole. I still call it as a Cold War. Means I don't think it was very different when we read the stories about US and Russia and so on. You will see that this is almost direct confrontation. US is taking control of this tanker, the oil tankers, and so on. So I would say this is getting little more than Cold War. I would call it a little more provocative. We are seeing China doing all these, exercises in the sea near Taiwan. They are almost threatening that. So there's a lot more risk, I would say, geopolitically, which is cropping up now. We are seeing that play out in energy markets, but it impacts a lot more than that, right? Means anything which is a direct provocation of China. And while the dependency of most of the US companies still exist on China, as we saw during the whole trade war, even though the tariff concerns have cooled down, but the original issue was not about tariff, but also, if you remember, when the whole Liberation Day tariffs were announced, that was a blockade. That was not a tariff. That was when you talk about 200% tariffs or 150% tariffs. those were not tariffs, those were blockades, those were wartime things. Now we have already set that precedent last year. Now we are talking about all these activities which are happening in terms of what is happening with Venezuela, especially with those oil tankers and so on. And now we are what can happen here is that at any point the market can be hit with not like tariff kind of news, but it can be some other kind of blockade, some other kind of stock specific impact can be big. One example is we people always talk about the whole semiconductor industry dependency on Taiwan. Any kind of action there, it can happen overnight. You will not be able to predict it. Nobody can say when China will make a move. Similarly, there is a lot of dependency in China manufacturing, and China can suddenly one day put I will not allow any shipments to go from here on a certain product. We are already hearing the news about China is limiting the silver export. So we are already hearing the news that China is trying to threaten that they will not allow the rare earth minerals to go out. All these things are being discussed at this moment on a daily basis. So geopolitically, I would say the risk is increasing in 2026, and it is getting hotter and hotter. So this is where one has to also be aware that the fundamentals sometimes don't matter. Sometimes you will not even know why, like a stock falls 10 or 20% just because some news came out which was impacting that stock more than the other stocks. And we saw this during tariffs, right? Means tariff wars. So this is, I would say, a very different world. It is a little more unstable as we go into 2026, and filtering out the companies which are dependent on which can be impacted more than some others which are less impacted. I would say that will be interesting, especially in the context of what is happening. As I said, between US and China on a day-to-day basis. All right, I see some more comments in the chat here, but yeah, as I said, feel free to put more. Um, this comment here is that the US sanctions had failed in 25. Are we now headed to test of physical prowess? I would say sanctions have been symbolic always. Um, I don't believe that sanctions are always anyway very effective for most of the U.S. companies, because whatever U.S. needs, they would always U.S. was still buying things from sanctioned countries whenever they based on their convenience. It's I would say it's more of a it's more about how they will be negotiating, right? Means nobody has the actual intent to go and get into a war in the modern days. Like other than Russia, I don't think anybody has shown intent to start a war. Of course, Israel is another one. So Russia and Israel are the only two countries who have shown in last, I would say, 10 years or so, which have started active wars. So it's the sanctions and these blockades. These are the ways which most of the countries are doing right now, and they continue. On the other hand, the whole supply chains, whole world was so globalized, and there are so many indirect ways these trade routes are established. You will see even after there was this whole news about that India stopped buying Russian oil. You will see that they are still going through. Even after Russian sanctions, US was buying so much different kind of nuclear fuel and many other things from Russia. Europe, which is actively involved in supporting a war against Russia, were actually trading with Russia. So when you talk about sanctions, they were not effective by design because the world is so interdependent, and based on the convenience, they decide where to put sanctions and where not to be. Um, so I think overall, it is right now it's a matter of where we are. So we are looking at more about where how these events take place. To be frank, I don't believe any of these things would last long unless there's an active confrontation. Most of these things are negotiated over. Nobody has appetite for pain because domestically everybody's struggling. If you look at US, means politically, as I said, there's an election year, so there cannot be any pain which they want to endure. Uh, they are not going to take any action which will endure, which will create pain towards the citizens. Similarly, if you look at China, they are struggling since COVID. Like they have had a big real estate crash. They had a lot of other issues internally. They have a population growth which has stopped, and the demand is not growing anymore. So their economy is needs stimulus all the time. So nobody has the appetite to create unrest in their own countries. So that is what keeps the whole economic engines alive. And I still believe that nothing's going to change from that perspective. You will still have pretty significant really similar things. All these sanctions, all these things will get resolved one way or other. But I think overall, I'm not too. Uh, these are mostly. When I talked about this whole geopolitical events, I'm talking about overnight impact on the stocks, because the news does impact the stocks. Does it really change the fundamentals? I don't think so. I don't think we have seen that during tariff wars. We probably will not see it in any of these things, because there is none of the governments have this appetite for creating long-term pains on their own people. So I think that's what we have seen in the modern world. And this is a much more nuanced topic. We can discuss it probably during our investor day, because we are trying to add a geopolitics session this time, like we did last year, because it does impact the market. All right, so I do see a couple of other questions. You seem to be more cautious than earlier. Should one rethink sectoral out of tech or geographical reallocation? It's a very interesting question, and we did touch upon this last year also one time. Um, I would say yes, there is an opportunity in geographically in some areas, but overall, if you see the market size and the whole dominance of US tech and so on, I would still be more excited about US tech. Of course, I would be, as I said, there will be we have to be careful in choosing which companies, but I think US tech still is leading, and there is hardly any other country geographically which is providing you the opportunities which US provides. Um, if you see like countries like China and everything, the market is pretty difficult to trade there. If you look at Europe, it is struggling economically. If you look at India, which is a demand-driven economy, it is struggling with devaluation in oil. Even though I would say India is probably one of the best place outside US right now because of the structural growth and the GDP growth and so on. But I think coming back to US tech versus rest of the world, I would still say that US tech has a higher growth rate. Uh, it is the highest promise because of what we are seeing. Like we did talk about the mega trends, right? Like AI is just showing the value of it, right? When the US tech companies have proven over and over again that they are able to generate way more revenues out of new technology. We are seeing how fast the FSD is evolving. We are seeing how fast some of these energy companies are now coming up with the new solutions. So overall, the innovation cycle outside in US and China is almost non-existent. Only US and China are innovating. And within US and China, Chinese markets are so difficult to trade and almost impossible to see through their real data. So I'm not a big fan of investing in Chinese companies based on my own experience with how how they are not transparent, very opaque markets, very illiquid markets, and retail-driven markets. So I think that's where the challenge is investing globally. In terms of sectorally, again, the answer is same. I would say what we are seeing in tech growth wise, probably there are some other sectors you can consider, like healthcare is definitely. But ultimately, the huge opportunities in healthcare is also because of tech, because of the new technological progresses in healthcare, and you can call it as biotech and so on. So, but again, those are unpredictable. They are very difficult to get the real data on those. While what you see, the benefit of tech investing is almost everything is happening in open. So as an investor, you are able to evaluate yourself the data. You are able to see the progress of AI. You are able to see there are open source benchmarks. There are a lot of other things which come out. The information availability in the tech is so much better than any other sector that would rather invest in those sectors which you can observe and you can track rather than some other sectors which are so opaque. Like healthcare is one example. Like a lot of we have done a lot of research. Like if you are a part of All Access, we have done one or two investments which done very well for us in the healthcare domain. But they're so difficult to find, and sometimes the information is almost you don't get that information at all. on how what is the real progress in the industry. And that's what I think is the biggest challenge. Rather than I'm not saying that they will not do better. I'm just saying that it is tough to invest in a measurable manner, in a more I would say planful manner where you can track the performance and so on. I see another question on crypto and BTC. Um, the question is, do you think they will suffer more later this year when investors receive their 401k accounts? I am not sure I understood that part. Um, uh,
Yeah, well, what I mean is that, people have tiptoed, especially older age, older demographic profile.
mhm,
They've tiptoed very little bit into
mhm,
putting their 401k or retirement account money into crypto assets. And when they receive those account reports and discuss with their advisors, they may, pull out, or they may not stomach the volatility or the negative
mhm.
returns when rest of the market went up. I don't know how important that is to the market,
Yeah.
uh, but that segment of the market which people were pretty, I think, optimistic about, it may as well pull back.
Okay. So my view on that is very simple. That retail, first of all, is very little, which moving the market. And even the advisors, if you see the growth in the crypto advisories, like if you look, see even last week, Morgan Stanley, which was out of crypto, they did not have any. They were actually not even allowing it. They just launched their own ETF at this late stage, and I'm sure once you're launching that, they must have this guidance for their advisors to go and say that go and buy crypto, right? So overall, I'm not seeing that changing. Is I'm sure more and more advisors are being educated by people like Morgan Stanley now. Previously, you had this Goldman Sachs and even some of the other big investment banks who were not supporting crypto very late in last year. They came out and they started supporting. So I don't think the advisors are going to say anything different. In fact, we are seeing more and more adoption right now of crypto and retail, and plus the passive investments which are coming in. Like that is huge, right? Means if you look at yeah, means even though there is this whole negative things around MicroStrategy, it is still part of Nasdaq 100. It is still it was retained into MSCI, even though there's the negative news is that they are not allowing the new shares created to be taken into the weightage. But overall, I would say the new allocations coming mostly were from institutions. I think it is still there's a lot of passive inflows coming, and there's a lot of um, I think growth in the advisors accepting crypto. So I don't think we are at the end of it. And I don't mean I'm to be frank, I don't understand the dynamics of if people really change. My feeling is that people are very hooked up these days into their portfolios, and because tools are it's not those days are over when people used to only see their report at the end of the year. Means usually people are able to, even the old people, I think there is enough mobile apps and so on that they are able to see things very regularly. And based on my understanding, the adoption in the old people, like really old people, was very low anyway for direct buying of crypto. So I don't think it means, at least I don't understand that to be a factor. I think it was mostly there are two factors which we discussed already last year, which were impacting crypto. One is, of course, this whole digital asset treasuries, which the whole war against them from the big banks, and you can see it very clearly that BlackRocks of the world, and now that Morgan Stanley is launching their ETF, all these big Fidelity of the world, these people wanted to own this, just like gold and silver. They wanted to own all the ways people invest using ETFs. That's why market went up in 2024 and onwards. And when digital asset treasuries like MicroStrategy started taking so much of allocation, they took away hundreds of billions of dollars away from that market. So this was a war which was started last year, late last year, and I think we are at the late stages of that now that the MSCI final decision is over. I think that is also behind us now. So they have used all their tools to fight it out. They were not able to get, definitely they killed a lot of new treasury companies, means almost all the new treasury companies other than MicroStrategy of the world or Bitmine and some of the top ones which are doing good. but the 170 or I heard 180 companies which are opened in the second half of last year, they are all struggling and they may not sustain. So I think they have managed to get this shaken out, this industry, and now we are fundamentals are not changed. And to be frank, if you forget about the correction, means we are means when the Bitcoin ETF was launched, we were at like what 40, $50,000 of Bitcoin. Even that is hardly 2 years ago, and we are still sitting at 90,000. We are 100% returns in 2 years since ETF launch. I think the industry is still calling it a success. Industry is still calling it as a bull run. It's very similar to when people were you cannot worry about Nvidia going from 150 to 85 earlier last year when you can go back to 210 based on the fundamentals. I would say that's a very similar situation in crypto right now. Um, the overall sentiment and the acceptability of crypto in the is increasing. I've not seen any data which shows that that is decreasing. Um, and as I think I did mention in I think the one of the weekly things we were putting that like the gold and silver are such huge accepted assets. And if you look at the chart, they had to wait 10 years flatlining before this rally which we are sitting on right now in last 2 years. Like if you go back to a whole decade of sideways movement when you have such a well accepted asset class. So Bitcoin right now is probably going through that consolidation, and it is, as we call it, as a digital gold and the whole thing. Even if it takes 6 months or 12 months for it to consolidate, it is still going to be considered as valid asset by them. And as I said, it's still 100% above 2 years ago period. Just 1 year of 3% negative performance or 5% negative performance will not shake up the industry yet. So I don't think structurally it is broken. I don't think it's a even if you consider those people who made losses, means it's very interesting that we only focus on 120,000 to 90,000, which is $30,000 drop. If we just zoom out a little bit, it is still 2x in 2 years. So I think um, some people, yes, are getting shaken out. People who are very narrow focused. But I would say Bitcoin is following the gold and silver trajectory. It is becoming a commodity which is accepted now in institutions. I don't think this is going to be anything different. It will go through consolidation periods. And we also saw a little bit of an inverse correlation with gold and silver. I think a lot of money allocation was going into gold and silver because of the rally. As the gold and silver saturate at some point after the whole China buying and so on slows down, I think we might see a little more interest in Bitcoin coming back again. That is my view. But again, I don't want to go speculate here in this call. We will have more details coming in. If you're part of our All Access, we do share very specific details of what we are seeing in these areas. My goal here in this, because it's a public call, I don't want to make statements which are speculative. But what I'm trying to highlight here is that none of these things are like, of course, as I said, there is a slight change in my view on will it be easy? Are we in a like early stage of AI trade or late stage? I would say we are in late stage. Are you going to say in gold and silver, are we in late stage or early stage? We are very late stage, I would say, in gold and silver. And Bitcoin, I would say, is still a very small asset class. And I still believe that it has a lot more room to grow just based on the acceptability and the like how many people have not even touched it. So even if some people drop out, I would say there is so many more coming in every day that it is nowhere close to being done, in my view. All right, so let me quickly look at through the comments more. So we are just going to take up one or two more questions quickly. We are almost at the top of the hour. Can you give a few examples of opacity in healthcare? Oh, so what I meant by opacity, it's not really about the corporate style opacity. I was talking about many of these things are like the opportunities exist when you have, like, say there's a new trial going on and there's some new approvals and there's a lot of money to be made there, and then you have this overall so those kind of things are very difficult to understand. Sometimes there are promises based on trial, first trial, second trial, and suddenly you see the trial fails and you have a big correction. Second thing is the opacity around the whole regulatory framework which is being reviewed every day, since especially since Trump came into power. I think we have this whole the new administration is pretty much anti, big healthcare companies. There's always this discussion about against insurance. There's a lot of issues which are, I would call it as, which are not in your control. You cannot just based on fundamentals that, oh, they are doing great and they have done, they have this huge research and they are doing, they're building this vaccine or they're building this treatment. You will get, a good fundamental analysis. What I meant by opacity is that in the healthcare, what happens is um, you have very limited ways to figure out whether the trial will be successful or not. You have very limited ways to know what kind of regulatory impact will be happening. And as an investor, it's much easier for you to get data on Gemini versus OpenAI versus two companies fighting for market and going with FDA trials. So it's that's what I meant by ability to see as an investor how much information you can get on these things is much easier in tech versus healthcare. So I hope I answered the question.
Can
And
I make
secondly,
a
of course,
quick
yes, go ahead.
comment? So, like,
Yeah,
I agree with that. The one drug blockbuster, but then the trial comes back negative, right? Yeah. So, but then, like, for example, to give you a specific example, like CRISPR, right? So, even though, so it has treated sickle cell, and those things have a huge implications because now we know all it needed was a proof of principle that it treated a disease that used to be, it was a chronic disease, it made from a chronic one-time intervention done. So because this is a proof of principle from at least from a like CRISPR. So that is one example. Other example I wanted to give about the weight loss drugs. So
hmm
that it's a problem. It has trial after trial, it is already established for weight loss. Now they are talking about addiction, Parkinson's disease, stuff like that. So, what are your thoughts about these two
yeah.
examples?
I think to be frank, like it's very easy for me to answer because you use CRISPR. So if you look at CRISPR, it is like for last 5 years almost, it is basically going sideways. Like it goes, and not just sideways, it goes like $40, it goes to $80, come back to $40, then it goes back to $80. And the news cycle means how do you even predict it? Because yes, it has a promise. Their timelines are 5 years, 10 years for development. They have this news cycle of, oh, there was a good success here, there was this failure there. As an investor, you keep getting whiplashed. um, so what I'm trying to highlight here is that there are no trends easy to catch. Weight loss was an easy trend. And I think that was a great investment opportunity because it was a huge market. It was a very huge market, and there was a you could invest after it came out, after it was successful. Then it was a matter of, as an investor, you can project how much it will grow. And but if you see, that played out very fast. So it was almost like, just like we call it catching the falling knife. Similarly, you are basically, you don't know where is the top. How long you invest. Um, and yes, I agree with you. There are some opportunities there, and we do keep investing in those. If you're part of All Access, we do talk about those. We did a very good successful investment in Madrigal, which was a interesting, FDA approval. After approval, actually, we invested, even double down on it, and went tracked that whole market. But even that, like, volatility is way higher in these kind of stocks. And if you go to bigger players like Pfizer and so on, they are like kind of dead stocks. It means even one discovery or one big thing doesn't change their revenues. So they are kind of very difficult to invest in. So that's what I meant. But again, means it's. I'm sure there are people who know how to invest better into this. I think because you can always play technically, you can play, just in the very bigger sectoral like ETF way. I'm sure there are a lot of ways. I'm not ruling out healthcare as an investment. I'm just saying that if, as an active investor, for me, tech and especially the US tech companies have a very good ethos, and there's a lot more trust around them. Evaluation is easy. Most of these things, software companies have made it so easy to invest because you can see that, like, almost every day you are using those things, you are seeing the progress. There are a lot of reviews every day which are actual user reviews or actual benchmarks which come out. If you talk about LLMs, like, it was very easy to know the day when Gemini came out and Gemini 3 came out, and within 24 to 48 hours you had very good benchmarks, you had comparisons. Everybody, and you can yourself test it out, and you can say, yes, this is a big change and big improvement, and suddenly you saw that. So I think that's what happened. I think where we means my view is that it's easier to track the technology innovations in the Silicon Valley versus what happens in healthcare. But again, it's probably it's our own strength. Like if you part of the Proflex community and the people I interact with, we have a lot more understanding of tech market than that. So I always believe in if you have better understanding of healthcare market, if you have better prediction ability, you should invest in what you like and what you know rather than following the trend. So again, I'm saying talking about my own limitations. We do get a lot of research, and as I said, we did play a few healthcare stocks based on our research. Uh, but it's as I said, have found navigating them a little more difficult. That's all I can say.
Thank
So,
you.
and let me take a last question. I think we're at the top of the hour. It says, any insights on memory market? I did talk a little bit at the start of the call, but I would say memory markets are cyclical. So as you know that right now, based on the research I'm reading, we are going through a huge demand and supply mismatch, and that will last for another 12 months. Now, it's very difficult to predict the top. So has it peaked? I don't know yet because when you are in this kind of a situation, the pricing power is now in the hands of the memory makers, right? It's because as we have seen with Nvidia, like when there was so much demand, their margins were going up and hitting 80% almost. We have seen this with the Apples of the world, right? And when you have a successful product, you can just increase the price and people will pay for it. And right now we are like, imagine if you have lined up 100 billion of budget, you are paying so much more money into, GPUs and, all the data centers build out. And you are not going to wait for memory prices to come down, or you are not going to not order the memory and you will try to get that allocation. And the memory makers have this pricing power right now. So you, when it will peak is anybody's guess, because that's the whole point of being in the market. And but what I can tell you is that the stock price usually peaks before the memory market peaks in terms of pricing, because market tries to always predict ahead of time. So at this moment, we are in the, I would say, the purple patch of the memory. But yeah, again, um, I would have to dig deeper into it before I start predicting. I still like some of the memory makers and some of these players. We have been making those trades in our managed portfolios, but overall, I would say it is something which I cannot speculate. But we are basically saying all I can say here without going to the edge of speculation. Next 12 months are going to be like the right now. The analysis is saying that the next 12 months the demand will be way higher than the supply. And also, one more thing you need to understand in the memory market is that usually in old days, because it's a commodity almost, big purchasers, they used to have a long-term contracts. And in these kind of conditions, what happens is when the pricing power goes in the hand of memory suppliers, they either can lock in longer term contracts at a discounted price, or they can take the risk of selling at the current prices. So there's a lot of dynamics which we need to understand company to company. Some companies are more conservative, some are a little more adventurous. So I would say just be watchful of, if you are really investing into the memory market and speculating in it, you need to really get into the next level detail and before you make a investment and chase the trend. But yes, I think one thing which I would say is you can have second level analysis of what will be the impact of higher memory prices on some other companies. And that's what we are doing in Proflex. I think it's much more difficult to track what will be the impact on each individual memory maker, but you can very easily see how the memory prices can impact the consumers of the memory. And those are the other ways to think about it. So, and there are a lot of other ancillary plays. What happens to the rest of the semiconductor when first we have a GPU boom, now we have a memory boom, and overall we are also seeing, like, since last quarter we have this whole TPU cycle. So there are a lot of other tools based investments and so on which we are looking into. So there's a lot of other things which one can look into. So that is how I would recommend thinking about, rather than directly chasing a trend which is so difficult to track at this moment.
Thanks, Raman. Thank you.
All right. No, I think this is a great discussion, guys. So it's nice to be back here on our weekly call. We'll try to keep it going. And again, a reminder that we are having our first investor day of the 2026 on February 1st. So we will post the links and everything so that you can book the early bird tickets. So do consider getting there on February 1st and keep your calendar free. And I think we'll dig deeper. I think we are getting a lot of data. Usually year end and early part of the years is the time when we ourselves get a lot of reports. We subscribe to a lot of paid research. So we are going through all that. We are preparing the summaries and what we are seeing in the market, what analysts are seeing, and then applying our own overlay on top of it, as we always do. So it's very interesting. I think I'm working on the data all through January for our first investor day. So do remember to come in there, and looking forward to see many of you, and also continuing these weekly calls now that we are all back in full action after the vacation. So again, happy New Year to everybody, and have a great time. And let's see you in, as I said, just keep your February 1st free for, I think we had great time last time. So we are going to try to keep the same consistent location and same format so that it gets the best value. Thank you. Bye-bye. Have a great weekend, guys.